Welcome back. Today, we want to first talk about major currencies and what are they. So major currencies, these are the strongest currencies in the world and the most traded currencies in the world. They constitute a larger percentage in the world forex reserves. So people also refer to the currencies we trade with the most as the majors. The majors make up approximately 85% of the foreign exchange market and therefore exhibit a very high market liquidity. Liquidity refers to how quick we can convert an asset into cash. The most liquid asset is cash. A very liquid currency is one that we can easily convert into local currency or from a local currency or from one currency to another. So a list of major currencies we have the United States dollar, you've got the British pound sterling, you've got the euro, we've got the Japanese yen, we've got the Swiss franc, we've got the Canadian dollar, we've got the Australian dollar, then we've got the New Zealand dollar. So these are the major currencies. So moving on. So when you're trading currencies, they are traded in pairs because you're exchanging one currency for another. So we have what we call major currency pairs. So with major currency pairs, these are the most traded currency pairs in the world, and we call them the majors. They constitute the largest share of the foreign exchange market, about 85%, and therefore they exhibit high market liquidity. So with major pairs, we are comparing the strongest economies or the strongest currencies in the world, comparing each and every one of them to the strongest economy, which is that of the United States. So all major pairs, they are paired to the United States dollar. So we've got the euro against the United States dollar, we've got the United States dollar against the Japanese yen, we've got the Great British Pound against the United States dollar. We've got the Australian dollar against the United States dollar. We've got the United States dollar against the Swiss franc. We've got the United States. We've got the New Zealand dollar against the United States dollar, and we've got the United States dollar against the Canadian dollar. So all the major currency pairs, they are paired to the United States dollar. We are taking the major currencies and comparing them to the biggest economy in the world, which is the United States dollar, since the dollar is the one which constitutes of the largest forex reserve. So the dollar is the king of the market. So the majors, we are comparing the other strong economies being compared to the strongest or the biggest economy, that is the United States dollar. Then we go to what we call cross-currency pairs. A cross-currency pair refers to a currency pair or transaction that does not involve the United States dollar. So a cross-currency transaction, for example, does not use the US dollar as a contract settlement currency. A cross-currency pair is one that consists of a pair of currencies traded in forex that does not include the United States dollar. So common cross-currency pairs involve the Euro-Japanese yen. We can talk of the Great British Pound against the Japanese yen. We can talk of the Australian dollar against the Japanese yen. So as long as it's not compared or paired to the United States dollar, it ceases to be the major currency pair. So for your homework, I would want you to go and find out about cross-currency pairs. I want you to bring me a list of yen cross pairs, pound cross pairs, and euro cross pairs. Then moving forward, we have what we call exotic pairs. So exotic pairs consist of a major currency alongside a tinily traded currency or an emerging market economy or a weak economy. So we are talking about comparing a strongest economy or a strongest currency being compared to an emerging or a weak economy. We can talk of the US dollar against the Mexican peso. We can talk of the United States dollar against the South African rand. The South African rand is far much weaker as compared to the United States dollar. So the exchange or the currency pair of the United States dollar against the South African rand gives us an exotic pair because we've got a strongest economy being compared to a weak or an emerging economy. So a benefit of trading exotic pairs is that they offer higher potential returns due to the wide price fluctuations. However, this means they are riskier also to trade. And exotic pairs, they make up a smaller share of the total forex market. They are generally illiquid, lacking market depth, and featuring low trading volumes, and they have got quite some bigger spreads. So moving on, we want to talk about how to read a forex quote. So like I said, currencies, they are quoted in pairs and they're traded in pairs, such as pound US dollar or the US dollar against the Japanese yen. The reason why they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling the other. So here's an example of a foreign exchange rate for the pound versus the United States dollar. So the pound against the US dollar, the first currency, we call it the base currency. The second one, we call it the quote currency, and this is the exchange rate. So what this means is for you to buy one Great British pound, you need $35 of the United States dollar to buy one Great British pound. So a currency pair is in quotation of two currencies in the foreign exchange market. We value one currency being quoted against the other. We call the two currencies in currency pairs the quote, the counter, and the base, which is the transaction currency. So the counter or the quote currency, this is the currency that we are using as a reference. In other words, the currency against which we are comparing the base currency. The base or the transaction currency, this is the currency that we quote in relation to the counter currency. So let me go a bit in depth in that so that I can explain this. So I want to use an example of Euro US dollar. If I have Euro US dollar, Euro US dollar. So for today's exchange rate, for the Euro US dollar, it's at around the Euro US dollar is around $1.09, which means that today's exchange rate for Euro US dollar is $1.09. And the advantage of trading on the forex market is you get the actual quotes from the interbank market. You get the quotes up until the last few cents. So if you go on Google or if you go to the bank, you might find the exchange rate only written as $0.09. But when you come to the forex market, when you open the forex market charts, you'll find it written as 1.0950 500 up until the last couple of cents. And this will be the actual interbank rate. So like we said this is the best, this is the quote currency pair. And let's say this is the quote. Which implies that when you are trading now, we are basing our assumptions based on the analysis that we would have done, based on the studies of the economy that we would have done to project where the currency is going to go based on the current market price. So if the current market price is at 1.09500 and we are projecting that is going to rise, to be a rise in the exchange rate and move to say about 1.09600, it means that this is an appreciation in exchange rate. The exchange rate has gone up, which means initially for you to buy €1, we were needing 1.09500. And if the exchange rate goes up, it means we now need 1.09600, which means the euro would have appreciated value against the United States dollar. So the act of appreciating, we call it a buy action or a long action, and that is the act of buying. So if we anticipate that the exchange rate is going to go up, we buy the base currency and we sell the quote currency. And if we anticipate that the exchange rate is going to go down, let's say from 1.09500 to 1.09400, it means we sell or go short which means we sell the currency that we anticipate is going to depreciate in value, and we buy the one that is going to get weak. Because if the exchange rate comes from 1.0500 down to 1.0400, it means the euro is depreciating in value and the United States dollar is actually appreciating in value. So furthermore on that, if we project that the base currency is going to appreciate, in value, we buy the base and sell the quote. That is, we buy the currency that we anticipate it will appreciate in value and sell one we anticipate will depreciate in value. So which means when we buy, we are projecting that the best currency is going to appreciate in value against the quote currency. Which means When now we are trading, we analyze the market from the current market position, and we predict the future of the currency, if it's going to appreciate or if it's going to depreciate. So if we project that it's going to appreciate, let's say the current market price is 1.09500, and we anticipate that it's going to appreciate. It means the act of buying, we are doing it at the current market price. And if it then goes up in our anticipated direction, it means we are going to realize a profit because the market would have moved in the predicted direction. And if it goes against the predicted direction, it means we are getting into a loss. So when one is trading, you are projecting if a potential future move the market is going to take, just like you're projecting that an asset is going to rise in value. So you invest before the rise of the value of the asset, so that as the asset rises, you are then realizing profit. And if we project that the best is going to weaken against the quote currency, we sell the best and buy the quote, i.e., we sell the currency we anticipate it will depreciate in value and buy one we anticipate it will appreciate in value. So by doing so, when you are trading on the CFD market, you are able to trade both ways just by predicting the direction the market is going to take. And it's going to go up or it's going to go down. It's unlike when you're trading stocks, whereby you have to wait for the stock price to go down and you buy, so that when it appreciates in value and you resell, you then get a profit. So in the CFD market, which we call the contract for derivative market, you don't have to physically own the asset. So moving on. So all the movement that is done on the forex market is measured in pips. So if an exchange rate moves from one price point to another price point, move from this price point to another price point, that movement here is measured in pips. So in this case, if the currency moves from 1.09500 to 1.09600, we say it have moved a certain number of pips. So the movement up or down is measured in what we call pips. So let's talk about what are pips. So a pip, it stands for percentage in point or point in percentage. So it is a very small measure of change in a currency pair. In the forex market, it can be measured in terms of the quote or in terms of the underlying currency. A pip is a standardized unit and is the smallest amount by which currency quote can change. It is usually 0.0001 of a dollar for the US dollar related currency pairs, which is more commonly referred to as 1/100th of 1% or 1 basis point. This standardized size helps to protect investors from huge losses. For example, if a pip was a 10 basis point, a 1 pip change would cause greater volatility in currency values. So after talking about 1/100th of a penny, one would ask, if prices are quoted to 1/100th of cents, how can you see any significant return on your investment when you trade forex? The answer is leverage. So when you trade forex, you are effectively borrowing the first currency into the pair you buy or sell the second currency. With a trading volume between 5 to 6 trillion a day market, the liquidity is so deep that liquidity providers, the big banks, basically allow you to trade with a leverage. To trade with a leverage, you simply set aside the required margin for your trading size. If you are trading 200:1 leverage, for example, you can trade 200 euro in the market while only setting aside 10 euro in margin in your trading account. For a 50:1 leverage, the same trade size will still only require about 40 euros in margin. This gives you much more exposure while keeping your capital investment down. But leverage doesn't just increase your potential profit, it can also increase your loss, which can exceed deposited funds. When you are new to forex, you should always start trading small with lower leverage ratios until you feel comfortable with the market. So now we want to talk about what is the bid and the ask price. So the term bid and ask, also known as bid and offer, refers to a two-way price quotation that indicates the best price at which the security can be sold and bought at a certain point in time. The bid price presents the maximum price that a buyer is willing to pay for a security. The ask price presents the minimum price that the seller is willing to receive for a security or an instrument or an asset. A trade or a transaction occurs after the buyer and the seller agree on a price for the security. The difference between the bid and the ask price, we call it the spread. It is a key indicator of the liquidity of the asset. In general, the smaller the spread, the better the liquidity. So most major pairs have got a small spread as compared to cross pairs and exotic pairs. So the forex transaction basics. So let's say you think the euro will increase in value against the US dollar. The pair in euro US dollar, since the first currency is the euro, which is the best, and you think it will go up, you buy the euro US dollar. And if you think the euro will go down against the US dollar, then you sell the euro US dollar, as I said earlier. So if the euro US dollar buy price is at 1.13404 and the sell price is at 1.13398, then the spread, which is the difference in the pips between the bid price and the ask price, it becomes 0.6 pips. So if the trade moves in your favor or against you, then once you cover the spread, you could make a profit or a loss. So the spread, we call it the cost of doing business. So just like on my right here, you can see that the sell price was 1.13398 and the buy price was 1.13404. So the bid price and the ask price, they are always different. And if we subtract the bid price and the ask price, we get what we call the spread, which is in this case 0.6 pips, which we call the cost of doing a transaction. So that brings us to the end of today's lecture. On our next lecture, we are going to talk about types of market analysis